Liquidity equals value. Let me say that again. Liquidity equals value. If you can't turn an asset into cash, if it doesn't generate free cash flow, if it can't survive when the credit markets freeze up, then you don't own an asset, you own a liability. And right now in 2026, we're watching the biggest liquidity crisis in commercial real estate since the financial crisis, and everybody's running around asking how this happened. I'll tell you how it happened. People forgot the fundamentals. They forgot that survival in downturns determines who wins long term. They forgot that the best money is made when everyone else is terrified. They forgot everything I've been saying for 50 years, and now the grave dancer is back. You want to know why they call me the grave dancer? Because I made my fortune buying assets that everyone else thought were dead. Savings and loan crisis, real estate depression of the early 90s, financial crisis. Every time the market crashes, every time there's blood in the streets, every time the so-called smart money is running for the exits, that's when I show up. Not because I'm smarter than everyone else, not because I have some crystal ball, but because I understand one simple thing that most people refuse to accept. Distress creates opportunity, panic creates mispricing. And if you have liquidity when everyone else is desperate, you can buy assets for pennies on the dollar and lock in returns that will compound for decades. But here's the thing. You can't be a grave dancer if you're dead, too. You can't buy distressed assets if you're over-leveraged. You can't take advantage of panic if you're the one panicking. You have to have dry powder. You have to have patience. You have to have the discipline to sit on the sidelines when everyone else is doing stupid deals at stupid prices. And that's what I've been doing for the last few years, while everyone was out there buying office buildings at 4 caps and apartment complexes with pro forma underwriting in retail centers based on the assumption that foot traffic would come back. I was selling. I was raising cash. I was getting liquid because I knew what was coming. How did I know? Because I've seen this movie before multiple times. The script is always the same. Central banks drop rates to stimulate the economy. Cheap money floods into assets. Buyers get aggressive. Leverage gets excessive. Underwriting gets sloppy. Cap rates compress. Valuations detach from fundamentals. And everyone convinces themselves that this time is different, that the old rules don't apply, that we've entered a new paradigm. Then something breaks. Rates go up. Credit tightens. Cash flow doesn't cover debt service. Refinancing becomes impossible, defaults spike, prices collapse, and suddenly all those brilliant investors who were geniuses on the way up are bankrupt on the way down. That's where we are now. The defaults are piling up. The banks are sitting on portfolios full of bad loans. Property values are down 30, 40, 50% from the peak. Transaction volume has collapsed because nobody can agree on price. Sellers are in denial. Buyers are waiting for capitulation. And in the middle of all this chaos, there's opportunity, massive opportunity, but only if you know what you're looking for, only if you understand how to separate real value from garbage, only if you have the capital and the conviction to act when everyone else is frozen. So what am I looking for? Same thing I've always looked for. Assets trading below replacement cost. Assets with real barriers to entry, assets that generate actual cash flow, not pro forma fantasy cash flow, assets where the downside is protected and the upside is asymmetric. I want to buy buildings for 60 cents on the dollar where I know that even in a terrible scenario, I can cover my costs and wait for the market to recover. And in a good scenario, I make 3, 4, 5 times my money over the next cycle. That's the grave dancer strategy. Buy low, buy right, buy when everyone else is scared, and then hold until the cycle turns. But you have to be selective. You can't just buy anything that's cheap. Cheap can get cheaper. Distressed can stay distressed for a long time. You need to understand why something is distressed. Is it a temporary liquidity problem or a permanent structural problem? Is it a bad location or a bad capital structure? Is it an over-leveraged owner who needs to sell, or a fundamentally flawed asset that nobody wants. These distinctions matter, because if you buy the wrong distressed asset, you're not a grave dancer, you're just another corpse. Let me give you an example. Office buildings. Everyone knows office is a disaster right now. Occupancy is down. Demand has structurally shifted because of remote work. Sublease space is everywhere. New construction that was in the pipeline is coming online into a market that doesn't need it. Values have cratered. So does that mean every office building is a buy? Hell no. Most office buildings are worthless. Second-tier markets, Class B and C buildings, old buildings with low ceilings and bad floor plates, buildings in locations where nobody wants to be, those are going to zero. You can buy them cheap and they'll get cheaper. The grave dancer strategy doesn't work there because there's no floor, there's no replacement cost argument, there's no path to stabilization. But what about Class A office buildings in prime urban locations? Buildings with great bones, good infrastructure, high ceilings, modern systems, buildings that are well located near transportation and amenities. Those buildings are getting hammered too, not because they're bad assets, but because they're over leveraged and the owners can't refinance. The debt is maturing. The building might be 70% occupied, which isn't great, but it's not catastrophic. The problem is the loan to value is 90% and the property doesn't appraise anymore. The lender wants the owner to pay down the loan. The owner doesn't have the cash. The lender forecloses, and suddenly you can buy a Class A building in a prime location for half of replacement cost. That's interesting to me, because I know that over the long term, the best buildings in the best locations will always have value. Office isn't going away completely. Companies still need space. They need less space, sure. They need it configured differently, absolutely. But they need quality space in quality locations. And you can't build a new Class A building in a prime urban core for anywhere near what these distressed assets are trading for. So if I can buy one of these buildings cheap, if I can ride out the downturn, if I can reposition it, maybe convert some of it to residential or lab space or something else, if I can wait for the market to stabilize, I'm going to make a fortune. That's grave dancing. Same logic applies to other asset classes. Multifamily, there are apartment buildings that got overbuilt, that are in markets with too much supply, that are bleeding occupancy, that have floating rate debt that's killing the owners. Some of those are bad investments. They're in the wrong location. They were poorly conceived. They're never going to stabilize, but some of them are good assets with bad balance sheets. They're in growing markets. They're well located. They're well built. The problem is the developer levered up at 90%, underwrote aggressive rent growth, and now the debt is resetting and they're underwater. If I can buy that asset at a basis where the existing cash flow covers my cost, where I have margin for error, where the fundamentals of the location support long-term demand, that's a grave dancing opportunity. Retail is trickier because e-commerce is a structural headwind, but even in retail there are opportunities, not in the dying malls, not in the strip centers anchored by bankrupt tenants, but in well-located grocery-anchored centers, in lifestyle centers, in affluent areas, in properties with strong co-tenancy and long-term leases with credit tenants. Those properties are getting swept up in the broader retail panic. Some of them are trading at distressed prices, not because they're bad assets, but because nobody wants to touch retail right now. If I can buy those at a steep discount to replacement cost with cash flow that covers my basis with a margin of safety, I'm interested. But here's what's critical. I'm not buying based on hope. I'm not buying based on the assumption that the market will recover quickly. I'm not buying based on some thesis about future demand. I'm buying based on what the asset generates today. What's the cash flow right now? What's my all-in basis? Do the numbers work at today's income? If the answer is yes, and I'm buying below replacement cost, and I have structural downside protection, then I'll do the deal. because I can afford to wait. I can afford to be patient. And when the cycle turns, and it always turns, I'm going to be positioned to benefit. The other thing I'm looking at is the debt side. There's going to be massive dislocation in commercial real estate debt. Banks are going to be forced sellers of loans. They're going to take portfolios of non-performing loans and auction them off at discounts. Debt funds that are over-leveraged are going to have to liquidate. Special servicers are going to be dumping REO properties. There's going to be a tsunami of distressed debt hitting the market over the next few years. And if you understand how to underwrite the collateral, if you understand the legal process, if you have the capital to move quickly, you can buy loans at 50, 60 cents on the dollar and either work out the borrower or take the property and end up with a great basis. I've done this before. I've bought pools of distressed loans. I've bought properties out of bankruptcy. I've bought from desperate sellers who had no choice. It's not pretty, it's not fun, but it's profitable. And that's what matters. I'm not running a charity, I'm running a business. And my job is to generate returns for my investors. The best way to do that is to buy when everyone else is selling, to be greedy when everyone else is fearful, to have conviction when everyone else is paralyzed. Now let me talk about something that most people miss. The grave dancer strategy isn't just about real estate, it's a mindset. It's about understanding cycles. It's about understanding that markets overshoot on the way up and overshoot on the way down. It's about being contrarian. It's about having the courage to act when conventional wisdom says you're crazy. I've been called crazy my whole career. I was crazy for buying REITs in the early 70s when nobody wanted them. I was crazy for buying distressed real estate in the 90s when the savings and loans were collapsing. I was crazy for selling at the top in 2007. I was crazy for raising cash in 2021 and 2022 when everyone else was deploying capital. And now I'm going to be called crazy for buying when everyone else thinks real estate is dead. But here's the thing, I'm not crazy, I'm disciplined. I have a framework, I stick to it. I don't get emotional, I don't get caught up in narratives. I don't care what CNBC says. I don't care what the investment banks are pitching. I care about math. I care about cash flow. I care about replacement cost. I care about supply and demand. And when those fundamentals align, when I can buy assets below intrinsic value with downside protection and asymmetric upside, I act. And when they don't align, when assets are overpriced and overleveraged and overowned, I sell or I sit on cash. It's that simple. The problem is most people can't do this. They can't sit on cash. They feel pressured to be invested. They have mandates. They have benchmarks. They have LPs who are asking why they're not putting capital to work. So they do deals that don't make sense. They pay prices that don't work. They convince themselves that they have to participate because everyone else is participating. And then when the market turns, they get killed. I don't have that problem. I don't care about benchmarks. I don't care about what everyone else is doing. I care about absolute returns. I care about not losing money. And if that means sitting on cash for 2 years waiting for the right opportunity, I'll do it. Let me also talk about the importance of operational capability. It's not enough to buy distressed assets cheap. You have to be able to manage them. You have to be able to reposition them. You have to be able to deal with tenant issues, leasing issues, capital improvements, financing. You can't just be a financial buyer. You have to be an operator. And that's where a lot of the private equity guys fail. They're great at raising money. They're great at financial engineering, but they don't know how to run buildings. They don't know how to manage through a downturn. They don't have the people. They don't have the systems. So they buy distressed assets thinking they're getting a bargain, and then they can't execute, they can't stabilize, they can't create value, and they end up losing money even though they bought cheap. I've been an operator my whole career. I started managing buildings when I was in law school. I know how to lease space, I know how to manage expenses, I know how to deal with contractors, I know how to finance, I know the entire value chain. So when I buy a distressed asset, I know exactly what I'm going to do with it. I know how to create value. I know how to improve operations. I know how to reposition, and that gives me an edge because I'm not just buying and hoping, I'm buying and executing, and execution is everything. The other thing I want to emphasize is the importance of local knowledge. Real estate is local. Every market is different. Every sub-market is different. You can't just look at national trends and make decisions. You have to understand the specific dynamics of the specific market you're investing in. What are the supply-demand fundamentals? What's the employment base? What are the demographics? What's the competitive landscape? What are the barriers to entry? Who are the major landlords? Who are the major tenants? What's the regulatory environment? All of this matters. And if you don't have boots on the ground, if you don't have local expertise, you're flying blind. I've always invested locally. I started in Chicago. I knew the market cold. I knew every building. I knew every landlord. I knew every broker. And that gave me an advantage. I could see opportunities that outsiders missed. I could move faster because I didn't have to spend 6 months doing due diligence on a market I didn't understand. And when I expanded to other markets, I either partnered with people who had local expertise or I spent the time to build it myself, because you can't be a grave dancer from 30,000 feet. You have to be on the ground. You have to understand the nuances. You have to know what you're buying. Now, I promised you that I'd tell you where I see the next major distortion forming, and here it is. Everyone's focused on the real estate crash. Everyone's talking about office and multifamily and retail, and those are real problems. Those are real opportunities, but they're also obvious. Everyone sees them. Everyone's going to be competing for those distressed assets. Pricing might not be as attractive as you think because there's going to be a lot of capital chasing the same deals. What almost nobody is paying attention to is what's happening in the industrial and logistics space. Now you might say, wait a minute, industrial has been the golden child. Industrial has been the best performing asset class. E-commerce is driving demand. Supply chains are being reconfigured. Everyone wants logistics facilities, and that's all true. That's why industrial assets got bid up to insane valuations. That's why cap rates compressed to the low threes. That's why every developer in the world started building warehouses. And now we have a problem. We overbuilt massively. The amount of industrial space under construction or recently delivered is staggering, and demand is slowing. E-commerce growth is normalizing. Retailers are right-sizing their networks. Some of the big tenants are pulling back, and suddenly you've got all this new supply hitting the market and not enough absorption. Vacancy is rising. Rents are flattening. And the developers who built these facilities at peak construction costs with floating rate debt are in trouble. But here's the opportunity. Industrial and logistics are still fundamentally sound long term. The secular trends are real. E-commerce isn't going away. Supply chains are still evolving. Last mile delivery is still critical. The problem is we have a near-term oversupply issue and a financing issue, which means we're going to see distress. We're going to see developers who can't lease up their buildings. We're going to see lenders foreclosing on projects. We're going to see industrial assets trading at discounts. And if you can identify the right assets, the ones that are well located, the ones that have modern specs, the ones that are in infill locations with strong demographics, the ones that just have a timing problem, not a structural problem, you can buy those at basis levels that will generate great returns once the market absorbs the excess supply. Because in 3 or 4 years, when the oversupply is absorbed, when demand catches up, when construction has slowed because nobody's financing new projects, you're going to have a supply-constrained market again, and the assets you bought cheap are going to be worth a lot more. That's the distortion. Everyone thinks industrial is overvalued, so they're ignoring it. But within the industrial sector, there's going to be massive dislocation. There's going to be distress. There's going to be grave dancing opportunities. You just have to be smart about where you look and what you buy. You can't buy every distressed warehouse. You have to focus on the ones with real long-term viability. So here's what I want you to take away from this. The grave dancer strategy is back. There's going to be massive opportunity over the next few years to buy quality real estate assets at distressed prices. But you have to be prepared. You have to have liquidity. You have to have discipline. You have to have operational capability. You have to be willing to move when everyone else is paralyzed. And you have to be able to distinguish between assets that are temporarily distressed and assets that are permanently impaired. Stop chasing trends. Stop listening to narratives. Stop believing that markets only go up. Understand that cycles are inevitable. Understand that the best returns are made in downturns, not in bull markets. Understand that survival is the prerequisite for success. And understand that free cash flow, replacement cost, and barriers to entry are the only things that matter. If you want to think like an owner instead of a speculator, if you want to build real wealth instead of just riding bubbles, hit subscribe, hit like, because I'm going to keep telling you the truth. I'm going to keep showing you how to think like a grave dancer. I'm going to keep emphasizing fundamentals over hype. Drop your investment theses in the comments. Tell me what you're seeing in your markets. Tell me where you think the opportunities are. Tell me where you think I'm wrong. I'll try to answer honestly, even if the truth is uncomfortable, because that's how you learn. That's how you get better. That's how you survive cycles and build generational wealth, not by being lucky, not by timing the market perfectly, but by understanding value, respecting risk, and having the courage to act when everyone else is afraid.